Good afternoon. Happy Wednesday. Welcome to another session of RM Smart Investing. Following up in our tradition for the last few months, I thought once a month it might be a good idea to analyze different industry. We've done the mining industry, we've done the food-related industry. And now with the opening of the economies around the world, I thought it would be timely with coming, the summertime coming. How about we focus on lodging and travel stocks, which are closely actually related. So with that in mind, what I like to do in this session, like to go over the factors which affect and influence the stocks in those two industries, the lodging and travel. And then we will focus on industry as a whole, and you will see that how correlated all the stocks are to each other. So it's important to understand the industry. And then we'll pick a couple of stocks, one stock from each industry, and we do an analysis of those stocks. As I mentioned, they're very much correlated to each other. So they're very much in line with the industry. So we will do that. And then we also review the correlations of these stocks with three main factors, or actually two big ones will be in that industry, how the interest rates affecting them and how the price of crude oil is affecting them, or the fuel. And the third one, because they're in, again, the travel industry, how the airlines will be correlated to price of these stocks. Last but not least, although we are again talking about different stocks, I thought there's a couple of small ETFs in the industries that I thought if you didn't want to invest in stocks, you might want to take a look at the ETFs. With that in mind, let's look at the factors. So I've come up with the 7 factors, which I think is important in today's environment as far as affecting these two industries. Number 1 will be the consumer behavior. And the second one will be the wealth effect. The pandemic, of course, it was huge, and we will review that. Goods versus services, the attitude of millennials, and then the retirement, as far as the retirees and the retirement goals and what are their objectives. The last but not least, unfortunately, this is to add to the whole criteria will be the Ukraine war and what's happening in Europe. So I believe the main factor for a lot of industries, but specifically in travel and in the cyclicals, is that the consumer psychology, consumer spending, and their behavior and attitude. So there are 5 determinants of the consumer spending. Number 1 is the disposable income. So the more obviously they have, the more consumer discretionary funds they are, the more they can spend. And it obviously affects the cyclicals and obviously the discretionary side of things. The second one is the income per capita. As we are making more money, obviously we can actually have more savings, but also we'll have the freedom of spending that. The third one would be income inequality. And the meaning for this is we don't want to have just a very small group owning most of the wealth, and really the resources will be mostly probably will do the investments, how many more cars or jets they can buy, or the real estate. So we'd like to have it more of a balanced, especially in like the middle class and the lower class. So they will have that they end up having hopefully discretionary spending. The fourth one is the household debt. And that's very important because if, again, the attitude will be whether the consumers are feeling positive about future, so they will take more debt to enjoy it, or they are very tight and they want to use their funds to pay down the debt. And talking about that, then we go to consumer expectations. The more positive they are, the more freedom they have in choosing some discretionary activities, and traveling will be obviously one of them. And that's why it's important to look at the consumer confidence. And those are the things that globally we want to watch. So the environment we are in, uh, obviously with the lower unemployment, there's concern obviously about the inflation, higher interest rates, the war. So all of these go hand in hand, but yet it looks like the consumer is resilient. So this is from April 13th, a week ago, when JP Morgan came with their numbers. At that time, this was before the opening, and we witnessed that the Norwegian cruise lines were up 4.57%. The Royal Caribbean was up 3.89%, and Marriott was up a little over 3%. So a lot of traveling stocks, they were trending 6.2, 4.1%, 7% higher. So basically, one of the factors were that the JP Morgan Chase CEO, Jamie Dimon, he kind of put the idea of struggling consumer. As you know, there's a lot of talk now about the recession. So based on his assumptions, in a sense, he thinks that the combined credit and debt and the debit spending was up 21% year over year, with the growth stronger in credit. And it says, as we see, it will continue, and the continued pickup in travel and dining. And basically, the whole idea is it was pretty positive as far as ongoing consumer confidence. And also, he saw he wasn't seeing any increase in delinquencies and these credit cards either. So the interesting factor is this happened on April 13th. Today, April 20th, Bank of America's CEO, Rob Moynihan, he came and reiterated what Dimon had said, and said that he feels confident that the economy is on the go and consumer are spending. So this tells us that wait a minute, there is that strength with the wages and other factors of again the confidence. People are willing to spend traveling, going to, at least if not too far, it could be either the flying somewhere, but also it could be a weekend activity. And that's where the hotels right now, they look attractive, and we will see when we look at the charts. So that would be one factor. The second factor is, it's been very much in the economy, is the wealth effect. And wealth effect is really perception. It's more of a psychology of things. So when the stock market has did well, like we look back on 2009 and on, and people are looking at their 401ks, they look at the individual investments, then we take into account the real estate. There is that, again, the feeling of, well, I do have enough so I can do other things. And we call that wealth effect. Again, we are living in a very different world based on, because of post-pandemic, and also because of what's happening with the war and now inflation. But if you look just to real estate or stock market, they have done pretty well. So that could be another effect that could influence the industry in traveling. The third one, which obviously we had not seen in 100 years, is the pandemic. And the pandemic completely took everything, made it upside down. So we did in 2017, as you will see, and then 2019, we were seeing this wealth effect, and the travel world was doing okay. And then this is what happened. And this is as of 2019, when the 2020, when it happened, that's where the expectation were. And basically, when we look at 2021, we look at the numbers, you see how the 2019 compared to 2020, what a big difference it was. So when we look around the regions around the world, we see from 2020 to 2019, average reduction in tourism was about 50%, Caribbean being one of the highest ones. So now the idea is the button and the really this rubber band was really stretched, and people staying at home, they just could not wait to get out. And initially, of course, they could not travel as far as like with the airlines, but they were traveling with the car. And a couple of years ago, actually, we did one of our sessions on RVs and on boating. People just could not stay home. Now, with the COVID really subsiding, and we looking, except now China having their difficulty with their zero tolerance policy, which is all over now. And what I mean all over, it's like they cannot decide what is the best thing to do. The rest of the world looks like they're opening. And based on that, I believe the airlines stopped the masking requirements a couple of days ago. So basically things are happening and people are ready to go. This might be the first real summer there will be a vacation. And the market shows us there's always markets a discounting mechanism. So the market is telling us that yes, there is a wave coming. So basically what we want to look at again, the economic pandemic influence from United States was the biggest, really the suffering was the biggest United States because it's such a large economy, and can see how much lower it was from 2020 to 2019. Of course, this is as of 2021 numbers, and Russia is still here. And the tourism still affects, especially some of these developing countries. In the past, we've talked about Thailand, for instance. It's a big tourist destination. We are, again, with the opening of the economy, that will help their GDP. And then, of course, on the other hand, a lot of Russians were big traveler, and I've seen they go, a big group of them, they go, for instance, to Turkey. They use, especially in summertime, and they go to uh, Central Asia, they go to Western and Eastern Asia. So we will talk about that. But as far as the COVID itself, things are looking more positive. The other idea is, it's granted, now I have funds to spend. Now, do I spend it on goods or services? And now this is very much related to the pandemics. And as you know, there was nothing to do. Nobody was able to really go to work in many instances, and everything was virtual. And so people are at home. And yet we have this stimulus money coming fiscally and monetary. The money is coming, we have this extra money. And so people started buying toys, really. So that's why they stayed at home. They started, trading, but also these online services, there's a retail services doing fantastically. So basically, with the opening of the economy, has the attitude changed? Are we moving now from goods to services, which is really experiences? For the first time, the families want to travel together. They want to fly together. So I put down this, again, once we are looking at the needs and wants. So here's the needs are still going to be obviously important. And that would be another segment and another class we should do on things. But the goods and services, the services now, with the people having the discretionary funds, being able to go out, will play a big role. So I think you see that there's a movement from goods to services, especially again with a lot of, we have a supply chain problem. So people are really working more on the experience now and enjoying their moments together. The other factor is the millennials. So we found out that millennials are more into the experience side of things. They're into downsizing. They don't want to have big houses and all the most modern furniture and all the biggest gadgets. So they are, as far as all the generations, they're the ones who are moving the fastest as far as really experiencing the life, which is the traveling and again enjoying those moments. So millennials are making travel a priority more than previous generations. And that's not a bad thing. This came in August of 2019, before pandemic. Now, millennials are the generation most likely to travel in 2021, and that continues. So again, they are moving from kind of an ownership society to more of an experience society. So these are some facts. I thought this is as of March 2022. So I'd like to share it with you because I think it is important to understand how the attitude of millennials are. So these are some statistics. So the first one, the overwhelming majority of millennials, 97%, they share their travel experience on social media. 2/3 post at least once a day. And this is that contagion, right? So it's like people, it's almost not a peer pressure, but just seeing that feel. In 2018, millennials spent $200 billion on travel, and 33% of millennials' budget was 5,000 plus on the vacations. The social media has a profound influence on booking choices, and that takes us to our travel industry and how it has become, a lot of things are being online. And with 87% of millennials indicating Facebook inspired their booking, and over 50% stating Pinterest or Twitter influenced their decisions. Around 86% of millennials chose experiencing a new culture over partying, which is 44%, and shopping. So again, this is the ownership versus the experience. There were 28% of them. Most millennials traveled during the past year, 82%. So this is for 2018, and compared to 75% of other generations. So this was updated in 2022, but I think that this was pre-2020. Upward of 65% millennials booked their travel with a smartphone, again, online, and 74% use one for travel research. Millennials take 69% more weekend trips, while only 13% of the other generations travel over the weekend. The average trip taken by millennials was 6.2 days versus 6.6 days for Gen Z, 6.4 days for Gen X, and 7.8 days for boomers. One half of millennials, 58%, lean towards solo travel, and 26% have done so. Nearly half of millennials with children, 44%, have traveled together. The majority, 62%, went with children under 5 years old. And finally, on average, millennials take 5.6 trips annually, compared with 4.4 per year for Gen Z and 4 per year for Gen X, and 3.5 per year for baby boomers. So I thought that was interesting, and that's the trend we can see. Now, from moving from millennials to the retirees, mostly the baby boomers. Now, the retirement travel, especially after pandemics, as you know, there are actually more people decided to retire, and they made those choices to actually enjoy life. Again, there were a lot of downsizing and a lot of retirees. Some of the retirees that I know, they decided to actually sell their houses and just travel. And especially with the presence of Airbnb, life has become become easier to travel to many more destinations. So what we have found out is emerging trends in this baby boomers or retirees travel plan. Number one, they like to have shorter itineraries, fewer than 21-day plus packages. There used to be some of them would go for 30 days. They will have these travel packages, tours. So it's getting shorter. Exotic locations, modern amenities. And they want to make sure it is in style. So they allow to go to exotic places. Multi-generational travel for extended families. And this is where the cruise lines become more attractive, actually, for the families to spend quality time together. Emphasis on local color, unique indigenous experiences, and the last but not least, the customized travel options, no herding. They, again, in the 90s and in 2000, there are a lot of, obviously there was a lot of tours going on, but now again, the unique experiences are becoming more important. The last but not least of the factors, obviously, this is not the positive thing, but it has happened, is how does the Ukraine, the war is affecting. So I partly mentioned from actually actual travelers from Russia. They are a big group of Russians. They do travel around the world. So that has affected because they really cannot travel much. They cannot take money out. So, but also obviously the energy prices have been a big factor. On top of that, it has affected the cruise liners. So like, let's say going to Black Sea, for instance, and put down the Viking cruises, they're canceled. This happened end of February, they announced it. And Regent Holidays also, they are looking at, they're going to upgrade it, update their information. But so it has affected the cruise liners going to that area, obviously. So now that we know the factors, let's look at, again, there's a big correlation between all the stocks in the same industry. And now you see how the factors play a huge role from the macro point of view. Now, depending on which the cycle we are, the traveling and lodging and leisure and gaming and casinos, they all come under the consumer cyclicals. So under consumer cyclicals, then we have different industries. Now, for the year, you see, this is as of last night, April 19, consumer cyclicals are up 3.44%. So they are one of the four winners as far as 11 sectors. They're one of the ones who are up for the year. And if you like to use an ETF for consumer cyclicals, the discretionaries, it's XLY, and you can see how they have performed and where we have been. You see the triple top there. So what we would like to do, now that we know the big picture, we want to go top down, and out of consumer cyclicals, we want to see how about their subsets, which industries. There are 23 industries in the consumer cyclicals, and how they have been doing. So basically, you see lodging is number 2 as far as performance. So that the winner were the department stores. Again, it goes back to the idea of people going out and shopping. But now you see the services, the lodging has done well. The other one is the travel. Number 4 is travel services, which are really flat. So that's the reason I want to look at these two and see how they, how we can take advantage of their movements. So let's start with lodging. And in lodging, now again, we're going top down, and little by little, we're taking the layers out. And this goes to the lodging. There's 11 stocks in the lodging. And basically, on a performance, I want to see what are the top performers. Marriott is up already year to date, 14.25%. And the Intercontinental is 5.67. We have the Hilton and Hyatt come next, and then we have Wyndham. So basically, this is the ranking of these hotels. And then once we look at the valuations, which, the first one, people look at the, so the price earnings, they are richly valued. But you will see that, again, there's a lot of other factors involved. So I think for industries like travel, like lodging, the macro plays much bigger role, and also individual stocks, you can see their differentiation, but it's all about the idea of experience than really, looking at what is the price earning growth, what is the price to cash flow. It's more involved, again, with the big picture, and they go hand in hand. So again, they are very richly valued, and we will go a little more in depth. So what I did, I decided, since we're talking lodging, let's look at just the 4, the Marriott, Hilton, Hyatt, and Wyndham. And again, when we compare their PE ratios, the price to sales, the price to book, the price to cash, far as the cash flow, they are, again, very richly rewarded. Again, we're coming from a big pandemic. So remember, there were a lot of fixed costs. The revenues had come down a lot. So they were this cost, and then we also have the variable cost. So, but we're looking at the earning per share this year, you see one of the reasons their price to earning is up because of the potential for the earning growth. And we will discuss it a little more. I also want to look at the financial side when the return to assets, to equity, to investments. Again, that is a lot of red flags. But again, because of it's the momentum, and at this time, it is the attitude and experience side of things. They are right now, they're more positive going forward. So one of the things we will see is the Wyndham will have their earnings on April 26th. We also have the Hilton coming up on May 3rd, and the other two will have toward middle of the May. So it's a food for thought for earnings. The other thing I want to look at is let's take a look at how the charts look. And as you can see, they're pretty similar. Marriott really has overperformed as far as the movement you can see, but also Hilton, and you see that it has been up a move compared to actual stock market. They've been stronger in most recent years, recent months, especially from beginning of 2022. And like Wyndham, obviously looks like a channel. And then we look at the Hyatt, it's just breaking out. It's not as strong as, let's say, Hilton and Marriott. But you see the compatibility. So one of the things you will notice with, and I chose these two, didn't want to, they're very similar. The beta, which is, again, this is part of our volatility. Also, we use it in the risk management, is the movement of individual stock compared to indexes. In this situation, we compare it to S&P. So the idea is, if a beta is 1, the $1 move in, or 1% move in S&P will translate to 1% move in the underlying security. If it is lower, then that means the security will move lower, whether it's down or up. If it's higher, then in a positive movement, it will move higher. So in this situation, with a beta of 1.68, for every 1% movement in S&P 500, Marriott will move 1.68%. So in the up days, they do much better. On the down days, they could lose more. So you want to be aware of that. The reason I want to bring this to your attention, you will see this is a common theme in all of these industry members. So, and you will even see more so in the travel related industry, you will see that the betas are pretty high. So this is a common thing. You want to pay attention to that. So basically, again, when the things are going well, we can see this is as of yesterday and today, Marriott had another nice day. So they do well. Let's move on to the travel services. The same idea as far as the travel services. There are 15 members, securities, and in them we have the Royal Caribbean, we have the Norwegian, the Expedia, Airbnb, the Trip, Carnival Cruise Line, so the Booking Online, so Travelzoo. These are all different ones. Based on the year to date, you see that Royal Caribbean is up 9.86 as of last night, and Norwegian is up 6.94. Expedia is up 3.11. So again, I chose about 5 in a kind of a different things. I chose 2 cruise liners, and then online, 2 online booking agencies, travel agencies, and then we of course we have Airbnb. So again, what you find out with the financials, there's a lot of, again, negativity. So be coming from pandemics. This was the same thing when we look at, for instance, the forward PE. Some are more attractive than our lodging companions, but other than that, it's still, again, you see a common theme from the valuation point of view. It is they're very richly priced, but the idea is the revenue side. Are they, especially in lodging, you will see that there's a lot more revenue growth coming, and that's what the key right now, the key emphasis is. So what I'm trying to say is we like to look at individual stocks. We want to find, that diamond in the rough, but with these, they really follow the big picture, the industry itself. So we can see again from the ownership, I want to look at the it has been any insider transactions. So we noticed the Trip had some recent, and then Norwegian Cruise Line was flat, but a lot of institutions own them. And you see there's been some movement from the institutions moving to, in the last quarter, moving to this arena. And you can see there's a high short, float short on the Norwegian Cruise Line. So looking at the charts again, there are, you see that there's still a little bit similarities when we look at the Royal Caribbean and Norwegian Cruise Line. And with the, again, war going on in Europe, we want to see how they are gonna react. One of the things we have noticed is, again, the lack of traveling, especially because of pandemic. Obviously, the cruise lines suffered a lot, and basically now still some of the ports are still closed. And I remember when I was in Florida a couple of years ago, I mean, all those ships were just sitting on ports doing nothing, but yet they were people who were actually employees, and they had to stay on those ships, and they could not get out because of the regulations, because of the pandemics. So they had to be fed, they had to get paid. And so there's a lot of costs which went with it with no revenue. So now things are changing, and basically, again, they are, with the help of the government, some of them, they are basically trying to work this out. So I'm not the most positive on cruise line, although a lot of people are going. I'm more positive on the lodging side for many reasons. But this could be you might find the value in a sense of, again, the momentum side of things rather than from the valuation. Again, as you will see from the PE ratios to price to cash flow, price to revenues, they are not there yet, but the potential is there. The same argument, I want to look at the Norwegian and the Royal Caribbean, look at the betas on these. So once they move, they really move. And when they go down, they really go down. So the beta, as you can see, both of them is over 2.5. So just a food for thought again for the beta. So what I decided to do, in interest of time, I said, well, let's choose one stock from each industry and just look at them and see how they're behaving and where we could go. So I chose Marriott and the Norwegian Cruise Line from each industry. So let's look at Marriott. Well, this is actually as of today, before the closing. You see the relative strength compared to S&P. They have been pretty strong, especially this month. And from the when we look at, they're kind of all over, but now the strength is going. One thing we have to make sure we want to see this continues. Our LRC, linear regression channel, we're getting to the top of the channel, so we want to be aware of that. Again, look at this past 5 days. It's been amazing for the Marriott. Very nice move. When I look at the weekly, on the other hand, obviously we see when the pandemic happened, the hotels suffered the most. So you see the relative strength was over negative 35%. So they suffered much more than the markets did. then we had the stimulus, and then we had the mandates coming and going, and then we ended up with the vaccination that helped the hotels. So we've been kind of all over, but right now, from the beginning of the year, you see the relative strength has been positive. Just be aware of this, again, the weekly linear regression channel. We might be getting a little overheated with the Marriott. Norwegian Cruise Line also has been strong compared to the S&P, although in a declining pace. You see it's a nice upward. We are right on the midline, so we want to watch that. But as you can see again, we were it was last year, I think it was about November when we had a lot of correction, they got beaten up. Obviously, if you recall, there was a talk of new variant coming, so that affected. But looking at the weekly and long term, look how much damage was done. I mean, you're looking at the relative strength of negative 60%. And as the economy started opening, they did well, but we are all over again. So we are really flat on a relative strength at this time. And we are close to upper edge, but there's still a little room for the movement. So I want to look at on a monthly basis, and let's take a look at what has happened to Marriott. Now, one thing you will see, obviously, this was the pandemic right here. And then we started moving, and then we had the vaccination. And then since then, it has been amazing. It's been tripled. Marriott has tripled since the low of the pandemic. Now, what you see here is, again, is more of that wealth effect. And the markets were doing well in December, or in 2018. There was correction in stock market right around here, and then the stock market in 2019 decided to move up. So this is very much in play with the wealth effect and also consumer spending. Cruise line is in a different world. It has obviously different expenditure. They do have a large fixed cost, and also fuel plays a role, not as much for, let's say, for Marriott. So with Marriott, as we will see on the correlations, people have to get there. So either they will drive, they might take a train, they might take airplanes. So those are different factors. For this, the cruise line, they are on the fuel. So, and also they have to really move from one place to another. And you see how badly it was affected just from COVID. This was huge blow. And we are almost not trying to get to the 50% retracement. And we did actually almost, hit that 50%. We got rejected. So we are kind of basing here. So it is, again, there's a lot more factors affecting the cruise liners than the lodging. So let's dive into a little more of the fundamentals. This is from the Thinkorswim. And let's look at the Marriott. So there's two areas. There's a lot of things I want to emphasize. You see that as of this moment, Marriott is a PE ratio, price to earning ratio, is at 49. The 5-year average is 41. So we are a little ahead of ourselves as far as the valuation from the price earning. But what you will see, the growth rates is actually at 61%, which is way ahead of what we had been. Obviously, the 3-year average is negative 13 due to pandemics. And in the 5-year average is 0.6. So this kind of justifies this rich PE ratio. So we want to pay attention to that. So that's why Marriott has performed well. And the other thing is the profit margins. They are at 32%. For the year over year, they're 139%. So once we look at on a yearly basis, you see that right now, after the 2020, which was big negative. The trend is up 2021, and we are moving up. So that's what you have to pay attention when we're analyzing, again, the you know, this industry, the lodging and the travel. These are what catches my eye. So this kind of justifies why Marriott has done so well. And, the other thing is also with the revenues coming in, which is, you can see, you look at the net income up 165%, and basically because of that, they can manage their variable costs. So with the higher interest rates, they do have enough room. So that will be managed. On the other hand, when we look at the Norwegian Cruise Line, you see that in reality, obviously you see why the 5-year average has been low, but even now, as far as the price earning, because of the earnings are negative, it is, and the revenues are negative. So there's not much justification. We have to look forward to see if they're willing, they will be able to, with all the costs that they have. Again, they have a high fixed cost, and this fuel is not helping. So although I hear basically that, I know it was last week or so, that the cruise liners, I don't know which one it was, I think maybe Carnival Cruise Line, they were booked at no time. So people are coming back. The question is there enough revenues to cover the high costs? So when we look at their net profits, income, and their margins, you see they're not looking too well. So we were negative last year. So we want to watch that. So this is one of the ways you can compare each individual. And, I looked at the Carnival Cruise, was not much, but it was like down 400%. So basically, this is one of the ways you can compare them, look at their net profit margins, look at their PE, but also the projected growth as far as the earnings go. And basically, again, we look at the costs. I mentioned the fuel. So what I want to look at, so I said I chose these two stocks. So with the interest rates going up, with the oil price of crude oil going up, how does it affect each individual stock? So again, Marriott is more of a stationary, cruise liners are obviously moving. And then we can combine those two, and you can check Expedia, for instance. You can look at like a TripAdvisor. So I just chose like Marriott. This is on a daily. And I want to see, first of all, the 10-year yield. How do they correlate to the interest rates? Now, for a while, they were correlated. So as the interest rates were moving, they were moving with them. But then you see over time, there is not really a big correlation with the interest rate. So I want to look at on a weekly basis. Oh, my apologies. I think I did the same. Okay. I want to look at this is the reason. So I want to look at, yes, I wanted to look at on a daily, on the 10-year, but also I want to look at, compare it to the crude oil. And this is what it is. So want to see if the crude oil has any correlations in the performance. And you see, again, we are all over. You can, it correlates 1-to-1, and it goes complete opposite. So basically, there wasn't much correlation. In December, there was pretty good correlation, but other than that, there was not much correlation. Then I look at the Norwegian Cruise Line. They had more correlation with the interest rates than the Marriott was. And of course, they had more correlation on the crude oil than Marriott was, which makes sense. And this is what I want to look at over the, again, the crude oil. Let's see. This is what I wanted to see. yeah, so on a weekly basis, you see it makes sense. There were for a long time, like for 2021, there was a high correlation, but right now there is not a big correlation between the crude oil and the price of um, cruise liners. So we want to see if there is any opposite correlation. If the crude oil is going down, would the stock go up? If the crude oil is going up, would this go down? So there is now, there's a negative correlation that we see. But again, on a long term, they kind of correlated to each other. As far as this other one I want to look at was, I thought, how about, again, we talk about traveling, what is the relationship between Marriott and the airline index as a whole? So look at this. I mean, the airline index is a big correlation of 92%. So you see that the large, in this case, Marriott, has a nice correlation to the airline industry. And on the other hand, once we go to on a weekly, we've had it for a long time, actually. It does make sense. On a weekly basis, it shows a little lower on a weekly right now. On the other hand, as far as the Norwegian cruise line, we see, again, very, very positive to the airline industry. And basically, just leave it at that on a weekly basis. I think that's self-explanatory. At the end, since we, as I mentioned, we are looking at the big picture with these, with the industries, and I thought, well, is there any way, rather than just doing individually, are there any ETFs? Unfortunately, there are not very liquid, and not many out there. There's one specific on the travel tech, which is, it's more of on the travel agencies and online, and it's called Away, and that's a travel tech ETF. And basically, what they do, they screen are really based on, I mean, they're basically on a global travel technology. And what we mean by that is, they're like Airbnb, Booking Holdings, Expedia, Uber, TripAdvisor. So these are and the companies, and these are the most of the countries that they're involved with. One of the things I always like to use these ETF, even if you don't invest in them, it's basically, it's good to know some of their holdings, some of the large holdings. If they believe in them, that might be a good starting point for you. As far as this ETF, you see pretty young, it's only 2 years old, and it's 284 million or $85 million assets under management. So that was one. Then it comes, there's another one for lodging. This just launched. So it is called Hotel, HOTL. Now, it's a very small one. It started in January. It's only 1.5 million under management, and it's basically it works with the hotel and lodging stocks from developed countries. You see the majority are in the United States, and obviously the big holdings are Airbnb, Marriott, Hilton, and Host Hotels, and Hyatt. So, and then Wyndham. I mean, those are the major ones that we have talked about. So basically, that's about it. I hope, again, this is just opening the door. Hopefully you feel a little more comfortable reviewing and looking at this industry, but you can see how correlated most of them are to each other. So with that in mind, I'm gonna start recording and open up for the questions.